Will a declining housing market bring down the rest of the U.S. economy? Well, we're going to be talking about that and more on the Gray Report, including a brand new inflation print. CPI is out today. We're going to be discussing that as well as other articles involving multifamily, commercial real estate, and the macro economy. You're not going to want to miss this episode of the Gray Report. All right, let's get into it. Welcome back to the Gray Report. I'm your host, Spencer Gray, joined by Dr. Matt Bosnagle, Director of Communications and Marketing here at Gray Capital and producer of the Gray Report. Make sure that you are subscribed to the Gray Capital YouTube channel. Follow along. We've got a great newsletter. But first, Matt, wow. CPI print today. Inflation is hot.
Yeah.
A little bit hotter than maybe some would like if they're looking for maybe a rate cut in the near future. But we've been expecting CPI to pop from all of this tariff talk and price increases. You've been spending the morning kind of digging into the numbers.
It doesn't look
Bring
like
us up to speed.
Yeah, it doesn't look like it's made a huge impact, but it does seem tantalizingly close to an impact, especially considering some of the monthly increases in things like furniture and toys and in some appliances. They've gone up about 1% and sometimes more for some of those categories. And you think, well, maybe it is starting to have an impact. Nothing dramatic though. So inflation went from 2.3 to 2.7. Not a huge big increase, and core inflation core inflation excludes energy and food prices, and that only went up from 2.3 to 2.4. There's still an increase though. We were looking for things to decrease, and it still seems like, at the very end I have a whole bunch of notes, but at the very end of it's the real important part, which is about interest rates and what the Fed's going to do.
Yeah.
Because inflation itself is not the story yet, I don't think. There's no scary numbers in here in this inflation report that would make it news necessarily in and of itself, other than the little tinklings of maybe tariff trouble. But I think that the implication on interest rates is more interesting, I think, really more newsworthy, and I think it makes Powell things stay the same. No cuts.
Well, I think that's what a lot of listeners are thinking about when they look at the CPI print of, not necessarily to your point of how more expensive or less expensive are things, but really what kind of signal will that give to the economy and the Federal Reserve when they make a decision whether to keep the Fed funds rate where it is, lower it or increase it even at the next FOMC meeting. Now, this isn't exactly strong evidence to reduce rates, although there's a lot of movement desire to reduce rates.
So the only thing I would add is first, I got the core inflation wrong. I was thinking of last month inflation went up from 2.3 to 2.4, and then this is another month of increases. It's these continued increases that we got to worry about, and if there's another month or two of these, then I don't see it's not that you can completely think twice about any rate cuts. It's that they get a lot less likely. And
some of this has to be seasonal, though, don't you think? So much more economic activity happens during the kind of the summer months, just like we see leasing activity. Doesn't typically economic activity kind of peak during the summer? And some of this, normalize for seasonality, could be close to a wash. I'm not saying that for 100% certainty, but I think that tracks
this balance too with remember people say that they were pushing forward their purchases because of the tariffs. There's probably different ways to interpret the increase. I think that this recent increase though from 2.3 to 2.7 is noteworthy for as big of a relative jump as it was compared to last month.
And what's driving that increase?
I'm glad that you asked. Food prices are up 3%, which is more than current, so that means it's a little bit pushing those prices up. Beef is up 10.6% year over year, and eggs 27% over the year. But actually, they're down 7%. Eggs are down since last month. So a lot of this that they're looking at, especially with tariffs, are these short-term monthly increases. And so for example, toys are up 1.8% this past month, and furnishings are up 1%. Appliances are up 1.9%. Again, all in 1 month. And if you expand that month,
So that's a monthly increase, not an annual.
not an annual increase. Yeah, these monthly increases are looking like annual increases. It's so big. That's how big they are. And
So toys.
that could be. Yeah, it's one less doll. Maybe only one doll.
Well, isn't that what Trump said?
what he
They'd
said.
be like, oh, maybe only have one Barbie.
Yeah. So, but
One doll.
I don't. Again, some of this is pretty volatile, and some of the monthly changes, it can come back down again. I'm not sure if there's a glaring signal because those are just cherry picked. Most of the items are doing fine, and in the jump isn't horribly big. Even the monthly increase was like 0.3 instead of 0.2 last month. So it's not like, here, let me actually check and see on the detailed summary. So last month it went from a 0.1 increase to a 0.3 increase, but still 0.3, that's not
three
huge.
times, Matt. That's 3 times.
I know. Well,
last month.
that's a good point. So maybe people should get worried. I don't think that it's at an absolute level at this moment that you should really be scared or anything like that. If anything, I think that we should look to those categories that maybe have room to fall. And one of them I would say is shelter, which got some coverage in some other news sources, and we're going to talk a little bit more about housing prices and how the home sale market is changing and stuff. But for CPI, shelter went down from 3.9 to 3.8 year-over-year increase. That's includes rent and home sales. Rent, just rent of primary resident went down from 3.81 to 3.76. It's still within a rounding, so you could still say that it's 3.8. It's the same, but it still went down if you dig right down like past the significant figures of what they're showing here. You spoke about the difference yesterday or last week between the rent growth data from Yardi Matrix, CoStar, and RealPage. You were disparaging CPI and saying maybe there's an ulterior motive hidden.
I didn't say. I'm just saying that. No. What I asked Matt, or what I said, I didn't say that there was an ulterior motive. I'm saying what I was saying is that what is the relevance and what when we look at shelter is a component of CPI. What actually is it telling us, and is it telling us anything useful?
Yeah.
And if it is a metric that there's not a lot of utility, and if one had the option to have CPI be higher or lower, and that impacts the decision of the Federal Reserve, I'm not again trying to be too much of a conspiracy theorist. My point was that it moves the needle, and major decisions affecting the entire macroeconomy. Like it's a pretty big deal. And we're looking at a metric. We're like, we don't even know if the metric is like a real metric, and it's such a big driver because what we're seeing, day to day, the reality of what's happening in terms of rent growth, looking at all of these higher frequency, rent trackers, it's not lining up with what CPI is printing. We're making all these decisions based off CPI, and so my question is, what's the real utility of CPI? And where the heck are they getting their numbers from? What's the methodology? Because if it's just a black box, which it's not a black box, it's got a bunch of people working really hard in an office somewhere doing a survey and doing some math. Thank you for your time. That's what I was getting at.
Oh no, I understand, and the differences are confounding a little bit because here, just throw this up. Please. So I put rent growth, which is rent of primary residence. That's the category in CPI that I'm using for this CPI rent growth. And then I took the CoStar numbers, which are the CoStar is in gray on this chart here, and the CPI is in I think it's dark blue. And if you look at the peak, then you'll see that it's about a year apart. So I think it's January for the CoStar one of 2021, and then January 2022 or 2023, I forget. Either way, a year apart of the peak, but the trough is like 2.5 years apart. It's basically over 2 times slower coming off of the peak. This is CPI rent than it did spike up. So it spiked up very closely in line. So I'm talking about CPI trends versus the CoStar trends. So first of all, the first thing about it is CPI lags. The second thing about it is the hill is a little bit it's a little more rounded. It's not as steep. But I think most importantly is the biggest difference between CPI and the private rent growth trackers that we've seen is coming off of the peak has been a lot shallower, has been just like a shallow slant instead of like the sharp come down that we had in about a year from CoStar. The rents shot down so quickly, but it hasn't done that yet. And I think there's even more room to fall, I would argue. It's just not anytime soon.
And I think that's where we were getting at yesterday is that we know, I mean, looking at these CoStar rents, you know, rents spiked and then they kind of came back down to earth, at least in terms of like growth rates. But CPI, which we're talking about rate of growth. We're not talking about, we're not talking about nominal numbers. We're talking about rate of growth. And the rate of growth that has never receded to normal levels. And so if you're growing at a higher rate of growth, you're compounding off of those previous numbers. And so it's just not giving a realistic picture of what people are actually paying. And again, unless I'm missing something, which I
think that part of it's the way it's calculated, obviously, and I think that maybe it's renewals. And there is like what CoStar measures. I don't know how much affordable housing they're measuring in their rent growth. So it's a whole different category, and it's a big part of it. So,
so I guess what I don't get is they got the uptake pretty good, the slope up, a little bit of a less an angle. It's obviously significantly delayed, but they got the general slope of the increase somewhat close, and the level. But what they're missing is the decompression, where in reality rents decompress relatively quickly, but according to CPI, there was this like long drag that we're still going through. Yeah. But we know in reality, it's not like all rents just, especially the rate of growth stopped kind of right away. So where is this is it just a delayed function of gathering the information? Yeah. But if that was the case, wouldn't the slope of the growth also be similar, kind of delayed in a sense? And it is delayed, but I guess the angle of slope would be somewhat similar.
Yeah, the two. It is a little bit of a mystery, but I keep thinking like, well, we are talking about some affordability issues, and if this represents the level of continued housing costs, then that's like a valid concern for people, and that could lead to people feeling like prices were inflated. I do think that rent growth, as measured by CPI, has further to go. Right now, it is at the normal levels, whatever normal was pre-pandemic, which is close to 4%, a little bit under 4%. That's where it just crossed that threshold of 4%, and I think there's got to be a little bit of an overreaction before it returns to those levels. Just like right now, in CoStar, we are currently in a period where it's about 2%, lower than pre-pandemic norms. Well, we've just got back to pre-pandemic norms for CPI rents. I think it's got maybe 1% to drop, maybe more. I don't know. It definitely does seem like it's going to be shallower than the drop in CoStar and other trackers from CPI.
I just wondered just the methodology, if we've updated our methodologies appropriately for measuring some of this stuff with just the extremes that took place during the pandemic. Are we using the right models?
Well, I think I was thinking about this too. It's like you're limited to the tools that you have. And I was like, well, they should just call everyone every month. And but RealPage and CoStar and other so CoStar maybe through Apartments.com, but RealPage through property management software, whether they're listing them like kind of Apartments.com does, or they're helping the property management like Yardi Matrix or RealPage does. They have data sources that are constantly feeding them in, and they're learning from each other. But I don't know if the government is allowed to do that. But I wonder if there's room for a public-private partnership at this point. That's what I'm thinking, is they need to have like a round table of these data sources and come to some kind of accord that's like, all right, we're going to get better data, and it'll be from there. It won't be just one source, so RealPage can't skew it, but yeah, that'd be fun.
If you think that if the BLS didn't produce, CPI, reports and updates, do you think the economy would keep going? Would we?
No.
Would we?
If a tree falls in the forest and an economist can't convert that to lumber figures and supply, then it never really fell.
But I'm saying, would there not be economists without the BLS? Would people? I mean, I guess Jay Parsons, all these people that are doing economics, people in universities with
No,
do they not do work?
Yeah.
I'm saying my point is like there's other sources of data out there. There's even better sources of data.
Like
and we're relying
Moody's
on
Analytics and stuff, and
and there's like competing sources that like you have to have good data to theoretically you need to be producing good data consistently to be able to have customers that want to buy your data or use your data to be trusted. Versus we've got the BLS, it's just one source of data that's putting it all out there, but we're kind of questioning how the validity of the sources. And then a pandemic happens, they stop working for a year, and then we have a gap in data.
I was thinking like maybe the government knows a little bit more about us than we think. It's just scratching the surface, but they should share it more. And that would be the drawback from my personal position is if we didn't have access to this, or if this information didn't exist, these updates from the government. And I think this is relevant.
Don't you think there's like a really good incentive for the market, the private sector to produce this type of information and
data?
They
would produce it, but you'd have to subscribe. And,
maybe.
But I think that this is irrelevant because this is in the news. And part of there were some rumblings like, oh, are they going to take away the Fred website functionality or some other? And I've noticed Fannie and Freddie don't do their research articles like they do anymore. Like they used to have Fannie Mae used to have a lengthy research report. Now I'm not saying they're not government connected, but they're quasi kind of. I think that someone's tightening the belts in there, and there just isn't as much free information that I like. Makes my job a lot easier rather than having to go to.
Is that something you've seen? Has Fannie and Freddie they've really reduced the amount of publications?
They went from monthly research reports, and like Fannie Mae had a monthly multifamily and economy, like housing and economy rundown with nice graphs, and they would have a special topic every month. I look forward to it. And now it's gone. Now it's just like simple data table.
If you go in the way, is it very clear? Like changing in administration, changes of administration. Like you saw the difference between.
Well, it's correlation. It's not causation. I don't know.
Well,
but it does seem like they're tightening the belt. You don't need to do this. It's and then they're gone. Yeah.
Well, that's an interesting story just in itself.
Yeah. So just to put a pin in this discussion, I did want to note Jay Parsons also had an article on CPI and rent growth. That was where the beeping was coming from.
That's on LinkedIn. People sending you messages.
Yeah. So I just wanted to skip straight to his takeaway. He says you can use this as evidence that stalled out home buyer market is not putting upward pressure on rent inflation. So just so people aren't really pouring away from the home buying market into the rental market. However, I think it is it is a little bit complicated. I think that there remains to be seen the specific effect of high home prices, the effect of overly high home prices on rental demand. I haven't read a report on that. I'd love to like hash things out with John, our data scientist, and see if we can find some kind of correlation. But short of some companies that have a survey that you fill out that's like, why are you moving out? Is it to buy a home? I haven't seen any data on like, all right, when the home prices increase at this level relative to rents that increase at this level, you're going to see a lot of more demand here or something. I really am calling on, I'll just have to do it myself. I think that's going to have to happen. But
yeah, but I get it. It's how much household formation is there going on, and that's going to be a much more the primary driver rather than it's a better time to buy versus it's a better time to rent. And so, but at some point. Mm-hmm. There's enough single-family buyers that turn into renters that do move the needle somewhat in some markets.
Yeah. Well, I mean, the median age of a home buyer is steadily rising, and that does imply that fewer people are buying homes. Or maybe it's a broader demographic shift. It's
I don't know where else they're going or what are they doing.
Yeah, they're getting roommates, or they living with their family maybe, or they're renting instead of buying a home. But just to kind of return to CPI, I think there's a lot of relevant shelter movements in shelter inflation, And I think that's going to be interesting to track. But most importantly is how this would impact the Fed's decision. I think that's going to have an immediate impact on whether you're buying, whether it's a home mortgage or whether you're in the apartment investment industry and you want to get a good rate so you can finally do a deal. It's going to have a big impact, and it's discouraging to see. It's like you would have to look for reasons to cut now, and this is one less reason. So I'm bummed.
Yeah. There's still a lot of pressure, to cut rates, whether it's now or later, later this year. I think the idea that, maybe that neutral rate, is just a little bit lower than where it was when the current, Fed funds rates were put in place. And we need to adjust for, again, just kind of where the neutral rate is.
Yeah.
But, where that kind of our star is always up for debate a little bit. So it's relatively subjective. Now, I want to move on to this piece, the cotality piece, the rising cost of staying put. I mean, we talk a lot about, home prices, the price of homes or the price of rent, but that's not the only reason, the big cost burden that's out there. Taxes and insurance are
they don't even get into maintenance issues that I always was. That's the big surprise. You buy a home and it's like, oh man, here's all the things that are wrong with it that you need to fix or maintain. And
I know it's tough, but I think these are the they call them uncontrollable expenses. Where CapEx, even though your hot water heater goes out, you don't have much of a chance about the you got to do something about it. But taxes, insurance, you got to pay your taxes. And if you want a mortgage, you're going to have insurance that you're going to have to pay along with that. And again, it's just the rate of growth. Some people just don't think that their insurance rates are going to go up or their property taxes are going to go up. When they look at that mortgage payment, they know what their interest payments are going to be and they know what taxes and insurance, and they project that, but they don't assume that their insurance is going to double or triple or property taxes are going to double.
What is part of the increase because the home values are increasing, and then that would raise your property taxes?
Sure, that's one way.
Because that's something that's like,
or do you get assessed? You could have been under assessed for years, and every state is different. Every county is different how they
because that's what I was thinking. Like taxes may not have. So insurance it seems like it's always going to increase along with inflation. Taxes not necessarily. In some places maybe property taxes go down, although I don't know. I'm not as plugged into that. I know didn't Indiana have has some kind of different law coming up? So I'm not sure.
Got the expert here.
Yeah, I know. Yeah. Well, I do
Indiana
know that,
just passed a bill, SB1, at the beginning of this year that essentially reduced some residential property taxes and multifamily property taxes. Yeah. Indiana also has a constitutional cap on property taxes.
Well, and I mention this because Indiana is one of, so they have a list of places with states with the highest year-over-year changes in mortgage delinquency. So they talk about insurance and property taxes as kind of a way like this is kind of why everyone is delinquent on their mortgages. And Indiana is ranked like 9th out of the 10th with a year-over-year increase of 13 basis points. So 0.13%. That's how much their delinquencies changed since last year. That's compared to Florida where delinquencies changed 0.38%, and they're linking this to an escrow, a percent of escrow change. So how much this escrow, which represents the taxes and insurance payments that you're paying to. That just represents the increase in taxes and insurance payments. It went up 62% in Florida. It went up 49% in Indiana. 49%. That's a big increase. Just among these ranked. That's pretty huge. I did have a slight problem, at least with these 10 states listed here. They are trying to make the association of the higher percentage change in escrow, the higher that increase, the more likely there's going to be a big increase in delinquencies. I don't know if that's perfectly connected because you have 62% escrow change in Florida. Well, you also and that's 38 basis points of delinquency change. But you also have 62% in Colorado, with only 13% of change. So maybe if they expand the numbers, it looks a little different. I do think, regardless of how it directly causes I think it is an added burden for affordability. It just adds the idea of homeownership as this place where the prices are so inflated, we don't know how deflated they are yet. And like when I was making my notes, I had this metaphor of like, it's like there is a pressure difference, and the prices could implode, and we need commerce to happen. We need buying and selling to happen in the single family home market for people to realize, oh, actually prices should be lower than they really are. But because because there's not enough homes to make that decision, there's this it's like a weird negative vacuum pressure, I think, in the housing market, which pretends like the future deflation maybe of housing prices or further softening at least.
I mean, we've talked about this in the past, but I mean, what's going to be that catalyst? I mean, it's going to be folks finally deciding that they need to sell that home and move and bite the bullet and say, maybe I'm going to have to be paying more, but I have to relocate. And the cost of this, I can't let my whole life dictate or be dictated by this house.
Yes, so that's a really good point. So in getting back to the title of the article, like some people can't afford to move. Some people can't afford to move because they're so tied to their job, and for whatever reason, a lot of you have this job and it's incredibly important. You can't find an affordable thing within a certain commuting time or maybe a bus route because you don't have a car. There are people that it's very tied to location, and that makes them even more vulnerable, I think, and it makes them even less likely probably to buy a home if they're looking at these costs. And I don't see any way out of it. So I think I don't even want to say a hidden cost, but it is an example of like you scratch the surface of the housing affordability crisis and you're going to see a lot of, it's not just mortgages, it's insurance, it's utilities, it's, it can bleed into a lot of different areas that are duly covered by the CPI. But I just wanted to point out that, that there's still demand out there, and even though the prices are softening, the weird part is we're still in an ultimate deficit of housing. And there's an article in Zillow that says a similar thing, that basically that we're down 4.7 million. We're down a lot, and it grew in 2023 instead of remaining stable, or we built like hell in 2023, and we still couldn't do anything because the demand was still there. The demand is so high, and I don't think anything happened since then that would imply that demand has decreased. So
we're not building.
We got a big backlog.
We've built a lot in certain markets, not enough everywhere. Because on the other hand, there's this other article. Nearly 1/3 of major U.S. housing markets now seeing falling home prices. So we have falling home prices. Still seeing gains in the Northeast and Midwest. Same thing with rent growth, which I think all of this corresponds. I guess maybe Matt, with our confusion is we're hearing like the housing market's in a rough shape. We're in the Midwest, things are pretty good.
Good point, yeah.
And so our perspective is a little bit different. Rents and single family home market in the Midwest and the Northeast very healthy. Other parts of the country, like the Northeast or the Sun Belt, are seeing declines, especially in places like Florida and Texas.
Yeah, the South and West for sure.
All that lines up with kind of Jay Parsons' comment of like housing demand is housing demand. If you're going to see a declining single family for sale home market, you're probably going to see a decline in rental growth as well. But I've got to tell you, there's been a lot of headlines of folks being really concerned about the housing market and speaking about it in national terms. Do you think that's correct, Matt? And can a decline of housing markets in the Sun Belt, Phoenix, Austin, places like that, bring down the rest of the housing markets and the U.S. economy, as some are suggesting?
Yeah, I don't think so, only because, like you were kind of describing earlier, there's so much variation, and really regional variation, with Midwest and Northeast doing a little bit better than the South and West. But the what also I kind of jumped the gun by talking about the Zillow thing. There's also a backlog of demand that even in the South and West, those are also places with incredible housing demand. So what is going to happen is maybe rent slips or home prices slip in the South and West, and they don't go down catastrophically because there are a lot of people that are going to pay for those because there's a lot of demand down there, and it won't have this chain reaction because I don't see a vulnerability underneath this. I just see a big amount of people that want and need homes and really can't afford it, whether it's for insurance or property taxes reasons or just a collection of things that they can't pay for and
so
they want
just,
to.
Gravity just needs to do its thing, and some of the very sky-high prices in the markets that, have overbuilt need to correct a little bit.
Did I tell you? I didn't, and I was trying to make a metaphor of this. I got a flat tire yesterday.
Oh, no.
And I didn't. I was pretty sure that I still hooked up the air, and nothing was happening. Because sometimes you see the tire rise as it fills up with air.
Maybe it's not that big of a, like a little bit of a leak.
And I was like, nothing. And I felt the treads on the tire just sank right through. I was like, there's nothing. And maybe that has a relation to the housing market.
So did you change your tire?
Oh, no, I went right across the street and I got a $55 tire.
Oh.
And the other one was flat, so I got to drive home, and I feel like I'm on borrowed time.
Yeah. See, that goes with your alignment over a period of time.
Yeah, that's a good point. I am due for a checkup, so I'm gonna have like.
But there's a tire shop across the street.
There was a tire shop across. It was at the Shell, and that
Oh yeah. Nice.
So it was scary. I knew it. I knew something was wrong. It was sliding a little bit. I was like, all right. So.
Oh man. Well, I'm glad you're okay. What was the analogy?
I was gonna say it was like the inflated or deflated prices. I didn't know there was no tire there until I felt it. I was like, oh man, there's nothing. I was trying to go with some kind of pressure analogy with but whatever. My tire's deflated. Home prices could be deflated.
So that much of this, all I can think, tire aside, it's so hard to get a good sense of where the economy is, where the housing market is, because there's not one answer is necessarily correct. There's so much nuance that is required, and that's it's for investors coming back to investing in multifamily apartments for a minute. It's natural to be a little confused and lack the certainty to make decisions, especially when you are allocating significant amount of capital. You're investing hundreds of thousands, millions of dollars into a deal. You don't want to be buying into a market when you think that it's crashing.
Yeah.
But you also don't want to believe that the market is crashing, but you're talking about the wrong market.
Yeah, you don't.
And that all markets are the same.
Yeah. You don't want to believe that it's crashing, but I think none of the numbers that we've been seeing have indicated like a crash. It all just seems like it's just so stagnant, and it's all these little movements up or little movements down, and nothing's really changing. And but I think that the interesting thing is like how much different it is if you look just beyond any things that are happening at the national level, because there are certain cities that are going great. There's their whole economy. It's not just the housing market, and there are others that aren't doing as well, and it just pays to dig into it just a little bit.
Yeah.
And so that that can kind of help.
And getting away from looking at it from like a national perspective.
Yeah, for sure.
And I think we do that sometimes too, just because we're talking about how are a lot of markets doing, and how it's multifamily generally doing in the United States. And sometimes there are national trends, global trends, but then there's state trends, MSA level trends, submarket trends.
Yeah.
And it all matters.
Totally.
It all matters. But because, again, like what we're seeing in the Midwest is so different from what people are experiencing in Florida, Texas, the Sun Belt, and elsewhere. The Northeast is different. Or Chicago, New York City. I mean, they're crushing it. San Francisco is like, getting like decent, growth right now. But Austin, Phoenix, not so much.
Yeah.
I mean, on the south side of Indianapolis, like it's incredible the amount of growth that's going on right now. The population growth, the amount of jobs, amount of retail. I mean, it's like a boom town, but then there's still not enough apartments. So you really have to ask ourselves what's going to happen.
Yeah.
I don't see anything but rent growth taking place.
Yeah. I think that what is interesting is none of the data that we're getting from the CPI or whether or rent growth or even really the general economy, we're not crashing yet. There still is not enough for really me to be certain about anything. I don't know what the next head fake
But
is.
there needs to be some kind of correction. I mean, when we look at those charts between like home prices and rents, rents, I mean, grew a decent amount back in 21, first half of 2022, and they basically kind of corrected, whereas single-family home prices have continued to grow.
Yeah.
And the ratio is so off that there needs to be, I mean, either rents need to rise substantially, which there's room to raise a little bit, but they can only raise so much relative to incomes. But single-family home prices have to come down, or interest rates need to come down materially. And just as we've talked about every single week on this show, it's not happening tomorrow or anytime soon, especially when we have a little bit of a hotter CPI print.
No, that was what I was thinking of at the beginning of coming up with these notes. Now I know we've talked a lot about housing in general and inflation, but what was been on my mind is like I think is these interest rates and how it just seems like so much is pinned on that. So much of the housing market, even just for the for sale housing market, is because interest rates are so high. And the same thing from multifamily. And it's just so frustrating to expect any kind of major move when the one key indicator is frozen in place and looks like it's going to stay frozen for a long time. So that's my despair. But maybe it also is like these housing markets and apartment markets need to just get used to it because like they've been wishing for so long, and I think outside of the people that are really in loan trouble, which we can talk about, and we'll probably be updating as we go. But I think that if you're buying or selling, you just have to kind of factor in this new reality that that maybe interest rates aren't going to be like they were pre 2020.
Yeah,
that's not the new reality, nor is the sub-zero interest rates that they were during the pandemic.
It is interesting. People still talk about that as a possibility of bringing those rates down to almost near zero again, or very low levels, at least the Fed funds rate, to steepen the curve, and then again there's just all this talk about changes at the Fed with now there's controversy. I saw Matt, you mentioned in the notes, talking Jerome Powell getting on him in the Fed for some change orders to the renovation plans at the Fed. Originally, I think the plan got approved in 2017.
Yeah.
Then there's been change orders since then, apparently.
Okay. Yeah.
And increased the budget, and so they're saying it's extravagant renovations. I think I forget if I was listening to Bloomberg or where, but it's can't they just print the money?
Yeah. Well, and. So yeah,
did they? Who are they paying? How are they paying?
They're self-funded. Obviously I know. They're self-funded, so they this is in whatever, and I'm pretty sure that we didn't just see this coming. This is not
it's an excuse to put some pressure on them. But again, I
was like, if he hires the wrong gardener, for if they pick an expensive landscaper, are they going to really axe him? I don't. Yeah.
Yeah, I mean. I can't decide. Should the Fed be some academic building that's kind of old and it's been that way for forever, or is it that's where all the money is created? So it should be maybe it's a little bit opulent.
Yeah.
I'm not saying it should be one way or the other. I'm just neither would surprise me, I guess. And so
I like the look of it. I've had to put that on
the building.
I've had to put it on my fair share of YouTube thumbnails and newsletter pictures.
Have you ever seen inside though? Have you ever seen inside those halls?
No. As long as they keep the
Is there a reason for that?
We'll never know where that $2 billion went. They say it went to really nice, marble flooring or whatever, but who knows?
You gotta have good floors.
Yeah.
It's important. You have to have a good foundation when you're fixing the price of money for the global economy. You need to have some nice marble floors.
Maybe that's what Jerome Powell will say upon questioning. It does seem predetermined. It is more likely that Jerome Powell will come before Congress and be questioned about the renovations than there will be a rate cut in the next 3 months.
What's the likelihood that they're able to somehow get Jerome Powell to resign early? First off.
That's a really big question.
And if so, can they get a friendly, chairman of the Fed in? But how much can just one person do? Because it's a committee.
Well, and
Just leadership,
then
obviously.
you look forward to. I wonder how many of the of Federal Reserve Board members in the next 4 years will be coming up for reappointment, and can there be a collective shift in the Fed over this 4 years to something that's more aligned with whatever the
You know, it's funny.
philosophy is?
To me, it's a little, Elizabeth Warren and
Yeah.
Donald Trump are on the same, team
Yeah.
in terms of like they want rates to be lower.
Yeah.
And, lower rates typically have been a more liberal dovish policy.
Mm-hmm.
And like the more fiscal hawks have typically been more like the Republicans and conservatives. Not always, because we're not, obviously different
Bring the
monetary
real estate
policy.
guy in here.
But the real estate guy,
Yeah.
like, wants the low rates.
Yeah.
I get it. But it's not just for real estate. It's for the national debt. I mean, I think that's really what they're looking at is they're, if we're serious about getting the deficit under control, a huge amount of the deficit now are interest payments on the debt.
Yeah.
And so as our debt turns over and we go from paying, relatively low rates, from the, the post GFC to, throughout the pandemic of very low rates to all of a sudden these newer, much higher,
Yeah.
longer term rates, that's just more load that the federal government has to bear.
I think I think the reason why Jerome Powell will stay, likely. I don't know how likely it is, but I think the reason why he would stay is because
Throughout
the
his
markets
term, at
would,
least.
it would spook
Yeah.
the markets if they replaced him. And I think that.
But if they replace him immediately with someone who's going to lower rates,
then it would
market would be pretty excited.
the market would be pretty excited. I don't know if that is a good question. The market would be
If they
pretty
just like
excited.
fired him, they're like, we don't know what we're going to do. We're
Yeah,
not sure.
yeah.
But even then the markets would be like, what do you got cooking?
Yeah.
Because I mean, again, it's like status quo. Otherwise, it's
Yeah.
like just we're going to kind of be in the stasis mode, and what's going to change. But I think maybe that is as much as we'd all love lower rates, but maybe the economy needs not necessarily higher rates, but like maybe we're in a range that's not too far off. And maybe they're a little
Yeah.
bit higher than they need to be.
Yeah.
But maybe the economy's kind of still cooking right now, and we're kind of at a sort of a neutral rate environment, and deals can get done, especially if we're going to see some growth, especially if we're going to see a little bit of inflation, as
Yeah.
kind of CPI showed. And there's an argument that we're slowing down, but we've had some very strong jobs reports, job numbers. We're hiring. There's the quits rates are not. They're healthy.
Yeah.
A lot of signs that the economy is in a good spot, and
Yep.
so what's the need to really lower rates? And like, unless it's really all you could justify is a maintenance adjustment of saying we really truly believe the neutral rate is just a tick lower, and so we're going to lower our rates a tick lower.
Yeah.
On the other hand, you have to say, is it worth moving rates lower if you're so close?
Yeah.
Just leave them where they're at.
Yeah. I agree. I at least from the perspective of like looking at deals and thinking about the deals that we've been looking through, at least.
You can get deals to pencil.
Yeah.
They're not like necessarily going to be crushing it like they did in 2017.
Yeah.
But there's also that the IRS could, if rates came down within the next 5 to 7 years, just your cash flow isn't there. It's still difficult, but not impossible to achieve positive leverage. Right now, you're really having to buy down if you're doing fixed rate financing, you typically have to buy down that interest rate, which means you basically have to prepay some of your interest
Yeah.
in order to have a lower rate, in order to get a positive interest rate cap rate spread.
Got it, yeah.
Which is what people are looking for, some positive leverage. You can do deals. I mean,
Yeah.
I would imagine that cap rates would be kind of in where they are, maybe a little bit. I think the B and C class cap rates probably need to expand a little bit, taking into account that risk, and
Yeah.
maybe the A class stays where they are for now
Yeah,
until rates change.
That makes sense only because those beings that they've become so close to
Yeah.
the A class, and I do wonder if. Just to raise the specter of loan maturities, if those C classes, if they'll start to enter, someone's got to sell them. It's the end of the road, and it happens in all kinds of businesses. It's okay, and suddenly it's horrible. It happens all at once. What is that thing for history. It moves slowly and then it happens all at once. Well, I'll put it in the notes. But that's what I think it's like. There's a little bit of denial in some of these places.
And I do believe there's going to be some movement. I don't know if it's going to be, market shattering or not. It's probably going to become just like piecemeal. But there's going to be a decent amount of transaction activity starting now throughout the end of the year.
Yeah.
And some of it's going to be people losing money, taking losses. And can the market just continue to absorb that? Right now there's so much demand, it looks like it will. But there's certainly, levels of where it can get kind of shaky and the market gets spooked.
Yeah.
But man, if anything, we're building some thick skin.
Yeah, I think for sure. Because this has been it's an underlying point in some of the reports. Especially, there's a report from RealPage that says essentially the same thing. It's like, there are a lot of shaky things about the economy that would maybe give you pause. Nothing, it's not horrible, but man, the resilient demand is a real influence on, I think, their projections, and they're projecting rent growth to jump up a lot more than we are actually, and I think they could have a case only because there is such there still is so much housing demand. There still is such a big deficit of housing. I've referenced that before, and that's seen not just in the single family home sales, it's also in the rental market, which had rents being stagnant for so long. I just think something's changing. I think that supply is changing, and that's going to play out in 2026 with higher rent growth. Maybe not higher than we project, because our projections are, let me just check my notes here. We project rents moving from about 1% to 1.5%, according to our latest research report, which you can get at graycapitalllc.com/future. We have rents 0.5% rent growth about from now until next year. Now, RealPage is projecting a full 1.8% increase, going from currently 0.5% rent growth to 2.3 by the end of the year. There's again talk about labor market resilience among this shaky economy, but I think a lot of this is supply. This is a supply story. This is maybe the last time where it will be as dramatic as it was, since we've had such this generation high of supply. I don't know, maybe in certain markets they'll see supply jump up like it never has been before, but I don't know if in my lifetime we'll see a huge amount of newly built apartments like we did in 2022 and 2023.
Well, let me ask you that. That's an interesting thing to say, and it's a very reasonable thing to say because it was a little unprecedented. Mm-hmm. Without that type of building activity, will we ever be able to get to a point where we have enough housing units? Isn't that type of building activity required? And actually, we need to build even more than that to get to a point of where we have enough housing for everybody? This is where
I can get a little bit pessimistic, because if you're talking on a longer scope of like 5, 10, 20 years maybe, there are demographic pressures of lower population growth. And I don't know what immigration took us such a big chunk, but if immigration continues to be low and our birth rate continues to be relatively low, we could see that deficit shrink naturally. And so I don't know if it's going to inspire a whole lot of building, as we've seen actually. So I do think it should. Based on the conditions now, people should be building homes. But they never have, or at least not in the past 2 years, seems like forever. And the one thing that needs to change is the mortgage rates. If they lower the mortgage rates, one effect is, sure, maybe it would be inflation, but I'm also sure there'd be a lot more home building and a lot more home buying. And so that's a short argument, but I don't think that we're going to see those increase anytime soon. And I wonder if we will finally see, home prices start to come down and rent prices start to go up. Yeah, we saw essentially the opposite, where rent prices were stagnant while home prices continued to go up. Now we might see softening in homes and the opposite movement in rents, not because it's against the rule of Jay Parsons. Yeah. They always move in tandem, but because high mortgage rates have or the construction spike in apartments was a lot more pronounced than the spike in single family homes.
I don't know. It seems like there's a lot of single family homes built. I don't have the data right in front of me, but there's a lot of homes that have been built in the last couple of years.
I was looking at it, and this is just from me glancing at the line graph that I had in in my head, and it was only single family. It did rise a little bit. It was more of a gradual rise through from the beginning of the end of the great financial crisis. So like since 2010.
But like middle of the pandemic, like I guess like 2019 through 2020.
Yeah, that spike wasn't necessarily as big as the multifamily spike, huge.
Yeah.
But there was a spike, just not as pronounced as multifamily.
Part of that is just because of the base inventory of single family homes.
You're right. I bet you're right there. That would make sense because there's a lot more single family homes.
And just a lot of a lot of like old, just a lot of inventory out there.
Yeah.
This is fascinating. Make sure you're subscribed to the Gray Report newsletter. It comes out every Thursday. We do a little digest on Sunday. GrayCapitalLLC.com/newsletter. And if you're an accredited investor, you don't want to miss out on the latest and greatest Gray Capital investment opportunity. Again, you have to be an accredited investor thanks to the SEC, but this is a smoking deal. It's in our backyard. Indianapolis MSA. It's a new deal, A-class. Room to raise rents. We still have a value add plan, fixed rate financing, huge co-investment from the GP side. Me, my family, GP team. I'm writing a very large check going in, fresh cash, not fees. A lot of alignment of interest. Investors always like that. So you're really just like investing right alongside of us. And, for all of this uncertainty, again, where we're buying, the absorption rate has been 150 to 250 units per quarter. This is like small submarket. Mm-hmm. There's only 200 units that are going to be delivered over the next 3 years.
Yeah.
And rent growth is already 5% in the submarket.
Yeah. It is, when we looked at this deal, I remember as you zoom in from Indianapolis closer and closer to the property, things get better. And it's not like it's, whether you're talking the submarket within the submarket or the larger section of town, and really even Indianapolis as a whole, all of them have different really good things going for it. And I'm also just really glad and excited that we're getting a deal in our hometown in Indianapolis. And it'll be very exciting. And
Yeah. So if you go to GrayCapitalLLC.com, again, if you're a accredited investor, there'll be a button. You can learn more or just get in touch with us, any member of the Gray Capital team, and we'll walk you through. We haven't announced it yet. We haven't given any details. We've been teasing like we are right now. So if you get in touch with the team right now, we can bring you up to speed on a private call and join on the Gray Capital team, partner with us. All right, thanks everyone. Make sure you subscribe. Catch you next week.